IRA, which is an acronym for Individual Retirement Account, is a tax-advantaged account. Although there are several different types, I'll just describe the two most popular, the traditional IRA and Roth IRA. These accounts differ from pension plans because they are not administered by employers. As the name suggests, these accounts are designed to help individuals save for retirement. Typically, they are opened and administered through financial institutions such as banks, mutual fund companies, and brokerage firms. Unlike pensions, which mostly give beneficiaries limited or no control of investing, IRAs allow you to choose to invest the money yourself, or if you want, you can have someone else do it for you. The traditional IRA allows tax deferral on contributions to reduce your income tax burden. That means, for example, if your income in 2015 is $60,000 and you contribute $5,000 to your traditional IRA, you will only pay income taxes on $55,000 in 2015. However, whether you withdraw before or after the minimum non-penalized age of 59.5, the withdrawal is taxed with income and capital gains taxes according to the tax bracket you're in at the time of withdrawal. The Roth IRA differs from the traditional IRA because it does not allow for tax deferrals on contributions. All contributions are taxed in the same year they were received in income, which means that you cannot use the Roth IRA to lower your income tax burden that year. The upside, though, is that the distributions are made tax-free. For example, in this case, if you have $60,000 of income in 2015 and contributed $5,000 to your Roth IRA, you will pay income tax on $60,000 in 2015, but when you receive distributions later on, you will only pay capital gains taxes. I bet you're asking yourself which of these two accounts makes sense for you. Well, on a basic level, if you anticipate that your tax bracket is lower when you contribute than it will be when you withdraw, it might make more sense to use a Roth IRA. This could be the case if you are young, early in your career, and expect to be making more money when you're receiving distributions. However, if the opposite is true, and you anticipate being in a lower tax bracket when you receive distributions, a traditional IRA probably makes more sense. On the other hand, time value of money and compounding can also be used to determine which account is befitting. Please note that you can have multiple IRA accounts, such as both traditional and Roth accounts, simultaneously. However, contribution limits set by the IRS determine the total contribution you can make to IRA accounts. That means if you have traditional and Roth IRA accounts simultaneously, the sum of contributions to both cannot exceed the IRS limit. The limit is either a set amount, such as $5,500 in 2015 if you're under 50 years old, or your taxable income. Whichever is lower will determine your limit. Please be sure to consider all your options when saving for your future.